Hello, I am Ishanuj Hazarika and this is my seminar presentation as part of course fulfillment for the course Blockchain Technology. The topic allotted to me is crypto investment. So, to quickly look into the table of contents, first we'll discuss a basic introduction to cryptocurrency. Next, we'll move on to top 5 altcoins to invest in 2022. Next, we'll see how to invest in cryptocurrency. And finally, we'll look at 4 different crypto investing strategies. So before we get into crypto investment, let's start off with the basics. So what is cryptocurrency? Cryptocurrency is a digital payment system that doesn't rely on banks to verify transactions. It's a peer-to-peer system that can enable anyone anywhere to send and receive payments. Instead of physical money carried around and exchanged in the real world, cryptocurrency payments exist purely as digital entries to an online database describing specific transactions. When you transfer cryptocurrency funds, the transactions are recorded in a public ledger. Cryptocurrency is stored in digital wallets. Cryptocurrency received its name because it uses encryption to verify transactions. This means advanced coding is involved in storing and transmitting cryptocurrency data between wallets and to public ledgers. The aim of encryption is to provide security and safety. The first cryptocurrency was Bitcoin, which was founded in 2009 and remains the best known today. Much of the interest in cryptocurrencies is to trade for profit, with speculators at times driving prices skyward. Next, we'll see how does cryptocurrency work. So cryptocurrencies run on a distributed public ledger called blockchain, a record of all transactions updated and held by currency holders. The units of cryptocurrency are created through a process called mining, which involves using computer power to solve complicated mathematical problems that generate coins. Users can also buy the currencies from brokers, then store and spend them using cryptographic wallets. If you own cryptocurrency, you don't own anything tangible. What you own is a key that allows you to move a record or a unit of measure from one person to another without a trusted third party. Although Bitcoin has been around since 2009, cryptocurrencies and applications of blockchain technology are still emerging in financial terms, and more uses are expected in the future. Transactions including bonds, stocks, and other financial assets could eventually be traded using the technology. A blockchain is an open, distributed ledger that records transactions in code. In practice, it's a little like a checkbook that's distributed across countless computers around the world. Transactions are recorded in blocks that are then linked together on a chain of previous cryptocurrency transactions. Imagine a book where you write down everything you spend money on each day, says Buchi Okaro, CEO and co-founder of African cryptocurrency exchange Quidex. Each page is similar to a block, and the entire book, a group of pages, is a blockchain. With a blockchain, everyone who uses a cryptocurrency has their own copy of this book to create a unified transaction record. Software logs each new transaction as it happens, and each copy of the blockchain is updated simultaneously with the new information, keeping all records identical and accurate. To prevent fraud, each transaction is checked using one of the two main validation techniques, which are proof of work or proof of stake. Firstly, proof of work and proof of stake are two different validation techniques used to verify transactions before they are added to a blockchain that reward verifiers with more cryptocurrency. Cryptocurrencies typically use either proof of work or proof of stake to verify transactions. Proof of work is a method of verifying transactions on a blockchain in which an algorithm provides a mathematical problem that computers race to solve, says Simon Oxenham, social media manager at Altcoins.com. Each participating computer, often referred to as a miner, solves a mathematical puzzle that helps verify a group of transactions, referred to as a block, then adds them to the blockchain ledger. The first computer to do so successfully is rewarded with a small amount of cryptocurrency for its efforts. The race to solve blockchain puzzles can require an intense amount of computer power and electricity. In practice, that means the miners might barely break even with the crypto they receive for validating transactions after considering the cost of power and computing resources. Proof of stake. To reduce the amount of power necessary to check transactions, some cryptocurrencies use a proof of stake verification method. With proof of stake, the number of transactions each person can verify is limited by the amount of cryptocurrency they are willing to stake or temporarily lock up in a communal safe for the chances to participate in the process. It's almost like bank collateral, says Okaro. Each person who stakes crypto is eligible to verify transactions, but the odds you will be chosen to do so increase with the amount you front. Because proof of stake removes energy-intensive equation solving, it's much more efficient than proof of work, allowing for faster verification times for transactions. Next, the role of consensus in crypto. Both proof of stake and proof of work rely on consensus mechanisms to verify transactions. This means while each uses individual users to verify transactions, each verified transaction must be checked and approved by the majority of ledger holders. For example, a hacker couldn't alter the blockchain ledger unless they successfully get at least 51% of the ledgers to match their fraudulent version. The amount of resources necessary to do so makes fraud unlikely. So we move on to the next section, which is top 5 altcoins to invest in 2022. 2021 was a breakthrough year for alternative coins, which is a term used to refer to cryptocurrencies that have no link to Bitcoin. Over the past few months, crypto infrastructure developed enough for people to invest independently in coins and blockchains with specific purposes without the need for blockchain as an intermediary. This is one reason why Bitcoin only returned around 60% last year, while coins like Solana and Terra grew by 11,000% and 12,000% respectively. Other coins like Litecoin and Bitcoin Cash also manage triple-digit returns. This shift in crypto world from brand name to specific value and protocols represents a watershed movement for the industry that is still fighting for mainstream recognition. The emergence of non-fungible tokens and DeFi applications also indicates that people are moving away from Ethereum, the second most popular coin, towards alternatives that offer lower fees and better speeds. Ethereum is transferring from a proof of work to a proof of stake consensus mechanism in the coming months that might tilt the market in its favor. Despite these changes, the prices of cryptocurrencies remain volatile as government weigh regulations on the industry. For beginners, investments in this sphere can often be boom or bust without proper information. For those who do not want direct exposure to digital coins, some of the top investments can be in companies heavily involved in the cryptoverse like Nvidia Corporation, MasterCard, and Alphabet Inc. The top 5 cryptocurrencies to invest in 2022 according to various sources are Polkadot, Cardano, Monero, Litecoin, and Chainlink. Although the list may be biased, the justification are as follows. First up is Polkadot. Polkadot is a cryptocurrency network that allows for distributed computing. This works as the Polkadot network consists of a central relay chain that coordinates parachains. The parachains allows developers to build chains for special purposes, for example, social networking, fintech, and other tasks. These parachains are then linked to the central relay chain and can interact with one another. The Polkadot network also includes on-chain governance, allowing users more say in the future development of the network. The network also includes forkless updates. The wider acceptance of coins like Polkadot has been facilitated by companies like Visa, a California-based payment firm. At the end of the third quarter of 2021, 143 hedge funds in the database of Insider Monkey held stakes worth $26 billion in Visa. The institutional trust in Visa helps suit investor concerns around crypto. Next, Cardano is a public blockchain ecosystem that just started offering smart contracts. Compared to other prominent coins that have this ability for years, the Cardano network is a new player in the arena. Frederick Gregard, the CEO of Cardano Foundation, the Swiss body that governs the Cardano ecosystem, recently said that the foundation was focused on ensuring maximum adoption and maximum utility to reach people in developing countries. This means that Cardano is one of the first coins with a focus on specific needs of developing nations. Next up, Monero is one of the most popular privacy coins on the market. The network on which it operates essentially masks information like the amount in crypto wallets or the kind of transactions a user has been making on the blockchain, even if the address of that user is publicly available. Monero was founded in 2014. The Monero network uses ring signatures to encrypt sender information, making it nearly impossible to identify the original source from which funds have been sent. Privacy coins like Monero are becoming more popular as payment firms like PayPal Holdings back their adoption. Next is Litecoin. Litecoin is one of the most popular Bitcoin spin-offs. The Litecoin network is run by the Litecoin Foundation, a body led by Charlie Lee, a former Google and Coinbase employee. Lee has likened Litecoin as a silver to Bitcoin's gold. The Litecoin network is similar to Bitcoin, but different in terms of transaction speeds, block generation time, hashing algorithm, and the maximum number of coins. Lee has also said that Litecoin, the layman's Bitcoin, Litecoin has a market cap of more than $8 billion. The final altcoin is Chainlink. Chainlink is a cryptocurrency used by the Chainlink network. The Chainlink network aims to streamline smart contracts by offering high quality and reliable data feeds to businesses so they can make use of that information to base contracts worth billions of trillions of dollars. These feeds can range from information about finance markets, the weather, and even sports results. Smart contract applications within the blockchain world usually rely on different datasets for validation of real-world data and typically use Oracle networks for the purpose. Next, we move on to how to invest in cryptocurrency. The crypto market cap is now about $300 billion with more than 1,500 crypto coins. It comes as no surprise that more and more people worldwide are deciding to get into this industry and start to invest in crypto. However, at the beginning, trading crypto can seem confusing, as the process itself differs from trading on fiat exchanges and what many investors and traders are used to. Today, we'll outline the 4 essential steps that will help you kick off your trading. Firstly, pick an exchange to trade on. Just like fiat finance, to invest in cryptocurrencies, you need a place where the coins are traded. To commence, you will need to register and put some funds into your account and then start buying and selling crypto. There are a number of popular crypto exchanges, for example, Coinbase, Poloniex, CEX, Bittrex, Bitfinex, Binance, KuCoin, among others. Such websites can have different terms of service and their trading platforms may differ a lot, so it is best to research and go through several reviews of exchanges. This will help you to choose a venue that suits you best. This leads us to the next step of obtaining a cryptocurrency wallet. As there are a lot of exchanges, investors have to transfer funds between them somehow and also have a place to store their assets. Cryptocurrency wallets are tools that allow you to store and send crypto coins back and forth. Crypto wallets keep your private keys, the passwords that give you access to your cryptocurrencies, safe and accessible, allowing you to send and receive cryptocurrencies like Bitcoin and Ethereum. They come in many forms, from hardware wallets like Ledger to mobile apps like Coinbase Wallet, which makes using crypto as easy as shopping with a credit card online. Unlike a normal wallet, which can hold actual cash, crypto wallets technically don't store your crypto. Your holdings live on the blockchain, but can only be accessed using a private key. Your keys prove your ownership of your digital money, and allow you to make transactions. If you lose your private keys, you lose access to your money. That's why it's important to keep your hardware wallet safe or use a trusted wallet provider. Almost all cryptocurrencies nowadays have their official wallets such as Bitcoin Core Wallet, Ethereum Wallet, or MyEther Wallet. You will find a link to the official wallet on most cryptocurrency websites. Multi-currency wallets are also available. Here are some examples like Jack's Wallet, Coinami, Exodus, etc. When you have chosen the wallets, you are all set and ready to start investing. The next step is research, research, and research. Cryptocurrencies are highly volatile assets whose prices can go up and down in large percentages in a few short hours. Such moves can be triggered by multiple events, so a crypto trader must constantly monitor market information. Before putting your money into a coin, it is a good idea to study the asset. One of the best tools for this research is CoinMarketCap, a website where you can find information on every coin and token available. The data includes capitalization, supply, trade volume, etc. So the site can be used for cryptocurrency comparisons. CryptoCompare is another useful site for this sort of data. The best way to track crypto-related news is to follow major publications and blogs in the industry like CoinDesk, News Bitcoin, The Merkle, and HackerNoon. Even more useful information can be found on social media, where you should dig into crypto-related subreddits, Telegram, and Discord channels. The fourth step is to use technology to enhance productivity and mitigate risk. By now you are equipped with some knowledge and instruments for trading. However, compared with the fiat investment process, there are still some elements missing. First of all, fiat investors can use stock indices for benchmarking when building their portfolio. Composites are perfect examples of such benchmarks. They allow investors to trade whole sectors easily and manage complicated portfolios in a straightforward investment, reducing the risk and volatility of the portfolio. You need to find similar tools for the crypto market. For example, Crypto Index 100 is an automated index calculated by a machine learning algorithm which analyzes cryptocurrencies. This tool allows traders to reduce volatility and risk for their portfolio as well as cost and effort inherent in investing in multiple coins, resulting in substantial savings in trading. After the portfolio is built, you can track coins via specialized apps such as Blockfolio or Delta, which provide valuable insights, which are real-time exchange prices, the order books for every coins, etc. Using such tools, you can also enhance your productivity. Next, we'll finally move on to the last section, which are 4 different crypto investing strategies. It's one thing to simply buy a bunch of crypto coins, but utilizing a strategy as you invest is a whole different ballgame. In its most basic form, an investment strategy is just a set of instructions that can help an investor make choices like what asset classes to buy, when to invest, and how much money to invest. Crypto investment and crypto trading strategies vary pretty dramatically. For example, you could choose to go for a conservative strategy that focuses on low risk portfolios and assets. This strategy would focus on the objective of protecting wealth. But on the other end of the spectrum, you might go for an aggressive strategy with high risk, high reward investments. The goal here would be capital appreciation. Every strategy has both risk and benefits. But to help you get a rough idea of how you can invest in a digital currency, let's explore a few of the most common crypto investing strategies. The first is buy and hold strategy. The top crypto investing strategy is called a buy and hold strategy. A lot of crypto investors refer to this strategy as HODL. Interesting fact is, most people think this is a typo that's gained traction over the years. But others maintain that HODL is an abbreviation for hold on for dear life. HODLing is when you buy a digital asset and then hold on to it in a digital wallet for a relatively long period of time. When you choose the buy and hold strategy, you are not really going to be doing much cryptocurrency trading. You simply buy coins and file them away. If you don't plan on selling any of your assets for years and years, then the hodl strategy is probably going to be the good choice for you, particularly if you are trying to build a nest egg for the kids in your life. Whether you choose hodl as a crypto investment strategy or sell cryptocurrencies, those are the decisions every cryptocurrency trader needs to make. Investors need to do their research before making any decisions. The next strategy is earning a yield. Another common crypto investing strategy is earning a yield, using which you buy crypto and then hold on to it to generate a financial return over a given time frames. The difference between earning a yield and hodling is that when earning a yield, you are only holding onto your crypto for a certain amount of time. The goal is to buy your coins at one price and then sell them at a higher price. A benefit of this investing strategy is that you can often earn passive income while you hold assets, sort of like how a savings account pays out interest on your existing balance. Dollar cost averaging. Dollar cost averaging is a crypto investing strategy that focuses on investing fixed amounts of your money into cryptocurrencies at regular intervals. This strategy operates on the basis that the crypto market often shows volatility, which means that timing is difficult. By investing relatively smaller amounts of money on a regular basis, you should theoretically be able to minimize your risk while maximizing your market exposures. Essentially, dollar cost averaging spreads your investments over time to insulate you from rapid price movements. That means the cost of your investment will get averaged over time. Value investing. Value investing is a crypto investing strategy that assumes most assets are undervalued, which means their actual worth is higher than the assets they are trading for. If you have ever heard of investor Warren Buffett, he is the one responsible for making value investing a pretty common investment strategy. Value investing is all about finding an asset you think is trading for less than its worth. You then purchase that asset under the assumption that its market price will go over time. The primary challenge here is figuring out which assets are genuinely undervalued. This strategy takes a lot of time, research, and practice if you want to generate a profit. In conclusion, at the end of the day, one thing is for certain: crypto isn't going anywhere. There are now over 8,000 cryptocurrencies to choose from, and a lot of those cryptos have been increasing in value. You just need to carefully consider which crypto investing strategy is right for you and your investment style. If you are trying to save for a child's financial future, your best bet is probably to invest in crypto using a UGMA custodial account, but just don't take our word for it. Thank you.